Welcome to episode 35 of the Minds Capital podcast, the show devoted to the growing world of independent sponsorship and entrepreneurial private equity. My name is Will Smith, and I'm here with my partners in Minds Capital, Max Lummis and Nicholas James. Today's conversation is with Ian Reynolds of Thesis Capital. We're thrilled to be in one of Ian's deals with Chris Kirsch leading that charge. Nicholas, what did you think of our conversation with Ian?
Yeah, we've gotten to know Ian a little bit since we invested in their deal in, August 2024? And it's been excellent to see the inside of Thesis Capital Partners. They were also recently recognized by being ranked as one of the top 20 independent sponsors by Axio. And so this episode was our opportunity to really get to know Ian more from a philosophical perspective. And I thought it was a rich conversation that covered a lot of ground, both tactically, and I'll get to those points in a second, and then more strategically about how he's built it to where he is today. Interestingly, if I reflect a little bit, Ian's first deal happened when he was in Houston. Well, he's still in Houston, but he closed a software deal in 2017 as a self-funded searcher. And if I reflect on my own journey, that was also my first deal. I was based in Houston in 2017 and closed a software deal as a self-funded searcher that year. So it's just fun to talk to someone smart like Ian and see what my life could have looked like if I had his qualities. And I really enjoyed hearing about how he's built out the portfolio to today to have 8 Portcos, had that early success, and really have a whole team of fantastic partners around him, including Chris, who we discussed in this episode, who is the partner in the deal that we participated in. I mentioned there were a couple of tactical points in here that I found interesting. The first one is that we talk a little bit about using an investment banker to help raise debt for your deal. They did that for the deal that we participated in. So he shares a little bit about why you should do this. And while we don't discuss the specific pricing of that particular deal, he suggests that these arrangements typically come in at 1 to 2% of the enterprise value is what you end up paying the investment banker to help you find not only the capital, but to find the right capital partner. The other nugget that came up for me that was interesting was, and we've never heard talks about this before actually, was the aversion to warrants. And so how this works is that a lender will typically come in, so say an SBIC, they will say, hey, here's our interest rate, 11%, and no amortization, but fully payable in 60 months, 5 years. And then on top of that, especially if they have a slightly lower interest rate, call it 10%, they will say, we will get 5% or maybe even 10% warrants. And that works for those who aren't familiar with warrants. A warrant is when someone in the cap table have the right to convert their position into equity. And so at a future date, that loan can be either repaid or it can be converted at particular terms that will be negotiated into X% ownership of the company. And so he said that they had received offers for some of their portcos from debt providers to have warrants. And he just was categorically no to that. And why? Because it dilutes the other shareholders, and just the existence of warrants are treacherous to other shareholders, and that lack of certainty can really affect the economics of the rest of the waterfall. So I thought that was a hard stance, but also well substantiated, and something that others should keep in mind as they structure their own deals. Because it's probably fairly easy to say yes to warrants because they're not here today. They don't eat into cash flows here and now, and they only really apply an upside scenario. But they do dilute the cap table, so you want to be careful.
Thanks for that, Nicholas. Yeah, I will just highlight our conversation with Ian about the model of Thesis, which we press him on. And there's a really great segment where he contrasts Thesis Capital to Salt Creek, to Novastone, to KSX. I had the impression going into the interview that Thesis was sort of in line with these other players as a sponsor incubator, if you like. I came away from the interview thinking that maybe less so. Maybe it's a bit of a more traditional model with operating partners. The listener can decide for themselves. We bumped up against Ian's limit there. He kind of wanted to keep the secret sauce for himself. So I think the exact characteristics of his model is part of the secret sauce of Thesis, and Ian didn't want to share that, understandably. But we still got a great kind of lay of the land of some of these other models and where Thesis fits in from that line of questioning. The other segment that I really enjoyed with in our conversation with Ian was about the traditional search model, or really the approach the traditional search investors are taking today. Ian's hypothesis is that it's become more the mentality of traditional search investors is more akin to venture investors, in the sense that they're seeing their portfolio returns determined by a power law distribution, where there's one or two giant winners that they then take the most interest in, which causes them to be less interested in the rest of their portfolio and what the implications of that are for traditional search and traditional searchers. So that was a really interesting take, and one I hope we hear from the traditional search investor community on for some actual first-person response to that take. So, Max, what did you think?
Well, firstly, I'd like to thank Starlink for making this portion of the podcast possible for me today, because I have a power outage at my house. So that's always handy to have as a backup form of internet. So going back and thinking about last week's podcast, the theme of partnership came up a lot, and the trend of independent sponsors partnering with one another or with groups like Thesis or KSX or Novastone. That's seeming to gain some popularity. As you said, Will, we didn't get a whole lot of detail on how Thesis is differentiated from those groups. But what Ian did say was that they're certainly people first. They interview 300 operators for every one that they choose to work with. They're very selective. It's highly personality driven, in addition to being skills based. I think the wording he used was, don't be a brilliant jerk. We're not interested in working with those types of people. I don't think anybody is. I mean, I'm not interested in working with those folks, either as colleagues or as clients. And so the personality is a very important trait that they are recruiting for. So again, though, it's going back to this theory or strategy of combining forces, combining resources in the independent sponsor space to execute deals and to build a long-term sustainable portfolio as a team. So that was interesting again, and a theme that's come up several times. Another thing that came up, which was near and dear to my heart, was Ian discussing capital providers and how they sometimes tend to over-diligence a deal. And so that was something worth listening to if you're a capital provider, particularly if you're a capital provider investing in independent sponsor deals. The sponsors are doing lots of diligence, of course, on the front end. Part of the benefit of investing in independent sponsor deals is that the deal comes to you very well packaged with a QV, with a leveraged buyout model, with pretty much as much diligence as you're going to get on the deal. So Ian did mention that he finds often that sometimes debt providers try to dig in a little too far and request additional information, which can stall the deal or even just cause that capital provider to get passed up. So I think we learned that early on, that we have to be nimble at Minds Capital in looking at deals, and speed is extremely important. So as Ian said, you do have to trust the sponsor to some extent. It's trust but verify. But I think there's a sweet spot for capital providers looking at these deals where you're doing enough diligence to, obviously protect yourself against a bad investment, but you're not necessarily reinventing the wheel when you come in sort of already on the goal line for a deal that's almost closed.
Yeah, that was an important observation by Ian for capital providers to hear. Well, before we turn to the interview, Nicholas, how about an update on our fundraise?
We opened our fundraise on September 29th, 3 weeks ago today, and we are a little bit past the halfway point of our fundraise for Fund 2. So I would say things are looking great, and we've had the chance to just connect with a whole range of fantastic people, business owners and entrepreneurs from throughout the country. So it's been a lot of fun. Several of them actually joined us on very short notice for our Investor Day in Dallas last week. So really enjoyed that, and kudos to those for getting on a plane right away and spending that day with us. So altogether, feeling great about onboarding new partners, and also seeing many of our partners from Fund 1 re-upping their commitment to Minds Capital. So thank you to all our partners.
And if you, listener, are an accredited investor, you can fill out the form on our website, mindscapital.co, to learn more about this and future fundraises. And of course, if you are an independent sponsor raising for a deal, we are always looking for great deals to invest in. So please get in touch with us at deal@mindscapital.co. And with that, here is episode 35 of the Minds Capital podcast with Ian Reynolds of Thesis Capital. Enjoy. Welcome to the Minds Capital podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James. Ian Reynolds runs Thesis Capital, a sponsor based in Houston. Thesis Capital was recently featured as one of Axial's top 20 independent sponsors. They've completed 8 platform acquisitions to date. Their typical deal falls between 20 and 80 million of total enterprise value, with EBITDA north of 4 million. And prior to starting Thesis in its current form, Ian had a successful run as a self-funded searcher with a software and services deal that he closed in 2017. Ian Reynolds, welcome to the Minds Capital podcast.
Thank you for having me.
So, Ian, we were just talking offline about Nicholas and I are, in the wake of the McGuire Woods week, which takes some recuperation, and asked your own experience with the conference. You don't go anymore, though you've been. Why don't you go anymore to McGuire Woods?
Yeah, I haven't been in a few years. I'm certainly something that I would visit again. Interesting, tidbit. Even with deals in hand, I haven't done any deals with anybody I've met at the conferences. So I'm not sure how that works, but it just has worked out that way. And so again, that's not to say that it can't be valuable. I think it gives people a very good lay of the land. But in all the deals we've done, we've not done a deal with somebody we met at a conference yet. So maybe in the future.
And do you find that now that you have capital relationships, you go back to the same capital sources? Of course, we were a recent addition to your capital sources, so I guess you're always widening the net. So I guess I've answered my own question, but to what extent do you return back to the same capital providers?
I think it's pretty serially. I mean, you build a relationship with people, you understand how they think, you develop a view of the world, and we definitely have people that are becoming, let's call it that first phone call. But also to a certain extent, it's different strokes for different folks, right? Some people like certain types of assets. They don't like other types of assets. Maybe there's a little bit of a hot hand fallacy that kind of plays into that, but it just is that way.
Mm-hmm. Let me put you on the spot, Ian, just since we're talking about capital providers.
Sure.
Is there anything that you've noticed that we could do better, or is there something where, and if you don't have an answer to that specific question, something that capital providers do that you like, don't do that you don't, or do that you don't like? Give us some either direct feedback or broad feedback on how capital providers can serve you better.
Yeah, I don't have any negative feedback for you guys. So it's put that way. You guys have been great. We look forward to continuing to partner with you guys. One of the characteristics of investors that has been problematic is they will go too deep right? And like all the information is there. You're gonna get the same access to the information that I have, the same access to the information that everybody has. And so seeking kind of like more or additional knowledge beyond a extremely comprehensive, data package and data room that we've put together for 2 years, generally is not going to get you into the deal, because we're time limited too. It's not a function of that we don't care or they're not thoughtful questions. It's a function of like, we're talking to other folks. We are busy. We're doing diligence. We're working on a post-close transaction plan. We still have things to navigate with the seller. And so, again, we to the extent possible, we try to answer those questions. But we have seen folks who go like PhD level deep, and it's been hard to partner with them.
But if you see that from their perspective, what is the right amount of diligence? Because in large cap private equity, there's a lot of CYA dynamics going on.
Yeah.
And in deal by deal lower middle market, I think you don't have the time, but you don't have as granular of information. The seller simply isn't resourceful enough to have extensive HR and insurance and legal data in the same way a large cap corporation could be. So where do you find that right balance as a capital provider? I assume you're talking, for instance, about SBIC lenders would be guilty of this.
Sometimes I think they have a compliance component that makes it a little bit more rough for them on the SBIC side. Even the private credit. I mean, we've done deals with like BDCs, and they have just levels of compliance that are it's just kind of silly, but you just kind of work through it. First, so 2 comments on that. The first comment is, actually, I'm in the process of hiring right now. We're trying to snag a VP from the the world of finance, and we're talking to some of these folks at, in some cases, very large funds, multi-billion-dollar funds. And a serial comment that I have heard multiple times is that they do almost no diligence, and it's in stark contrast to the level of depth that we have and require even for ourselves, where to a certain extent they're just like, we just kind of have to trust the sell side banker, right? For some of these deals, we have to just trust the private equity sponsor when we're putting money into these deals, and these are again mega funds, right? So AUM north of $1 billion. But we've interviewed. We're looking for this VP role. We've interviewed probably 65 people, and at varying stages. That's not to say we've taken everybody through every stage. And a comment we have heard serially is that like folks are not doing diligence, because one of the skill sets, of course, we're looking for is, okay, what actual diligence have you done on a transaction? And at the upper end of the market, you'd be very surprised that skill set actually just doesn't exist. It's not something that happens.
I'm very surprised. What the hell are they doing all day long? I mean, they overpay for assets. They don't do due diligence, and they're not hands-on post-transaction. So how's this possible?
I don't know. But the reason folks I think are interested in working with us is the comment we've heard back is that they're not a cog in the machine, or at least that's the hope. So it's a question I have too.
Ian, I had mentioned your recent recognition by Axial. What does it take to be named a top 20 independent sponsor? And by the way, again, coming off of McGuire Woods, top 20 is pretty exclusive. There are ever more independent sponsors. We saw hundreds and hundreds of them in person in Dallas just a few days ago. So that's a pretty elite strata to be in.
Yeah, I mean it's a great recognition, I think, of the work that we've done over the last few years. And so my wife said, "No, there you go." Right? I don't know what is required. The way I look at it is. So I, have kids, and they're in various sports programs. My daughter is in swimming. My oldest daughter is in swimming, as is my middle daughter. And the thing I tell them is, you're not running a race against someone else. You're running a race against yourself. Actually, when in swimming, you're really competing with your own time. Is really what you're doing. So. We just try to be really focused on our own process and go as deep and as hard as we can against what we know to do well, and these things sort of take care of themselves.
Great. Well, maybe this will help answer the question. Your model has a particular flavor to it that is a little bit different than your kind of down the fairway independent sponsor model. Define it for us. Share how Thesis works.
Yeah, and happy to define it. We were not this way out of the gate. I mean, we had to sort of discover this, but our model is very, very simple. We find extraordinary people, build a thesis around their gifts. And when I say gifts, I mean, like, we're trying to figure out what their gifts are, and then back them in markets that we understand. There's a lot of stuff I don't understand. And then, of course, we're looking for the economic characteristics of an enduring business. And we want something fundamentally that isn't going to die, actually. And so on the economic characteristics, really what you want to underwrite to is something that would, in a certain respect, be hard to kill as a business.
Yeah.
And so that's the business model in a nutshell. Now, was it always that way? Absolutely not. So, but in the last, let's call it 4 years, that's what it's become.
Well, my impression, Ian, though, is that at Thesis, the way you work with your operators, recruit, find operators, pair those operators with opportunities is a little bit different. Can you double click on that?
Yeah. So let me go into the kind of gifts and talents component of that discussion first, and feel free to bring me any number of ways. But our sort of core philosophy is like people are like a rubber band, and you could stretch that rubber band in any direction, and you're going to go back to that default shape. And you have folks who have certain sets of behavioral characteristics that make them exceptionally well positioned for running these businesses. I think if we were going to like bifurcate between let's call it traditional, well-known search program, you have to be a very good acquirer and a very good operator. In my view, that combination of talent is actually quite rare, and they're typically, you're not going to find someone who's, let's call it, the best thing since sliced bread, is the best acquirer of businesses and also the best operator. Yeah. I think it's much easier to find a better operator than it is to find that kind of combination. And so what we do is we pay a lot of attention to who we're bringing in, what is their skill set, what is their behavioral set of characteristics, not just their background experience, although that's really important to us because we're, again, building an industry thesis around them. And we are looking for a really specific set of criteria where we know, based on our pedigree of getting stuff done and having successful growth in the companies that we have acquired, that we can be successful with that person. Now, are we going to get it 100% right? Absolutely not. I wouldn't sit here and tell you that. But we have defined a set of criteria that works really well for us. So at a fundamental level, we're building people at the same time we're building businesses.
But Ian, this model is more than just the operating partner model. This is something deeper than that, right?
It is. I mean, we want folks to be a part of the ecosystem, not just through a single transaction, but ultimately all the way, past the next go round, right? So that's a component of it. We are uniquely hands-on, right? So it's not just, hey, here's deal flow and good luck, here's a pat on the back, and call us if you need us. We are meeting with folks multiple times a day, serially, honing the thesis, testing markets, running marketing, speaking with sellers. I mean, I'm on as many calls with sellers as the executives in residence, and then validating that these opportunities we're going after are sound, and they sort of meet the investment criteria necessary for not just the business to be successful, but also the entrepreneur. And we look at it fundamentally as a puzzle where you're trying to get the right entrepreneur in the right opportunity. We very often encounter a very good opportunity, but not something that we can transact because we don't have the right entrepreneur, right? And that's a challenge I hope to solve in the future. But if we have the right business but the wrong person, we just won't do the deal.
The way you work with the entrepreneurs, is it like a formalized program? I'm thinking of like a Novastone or KSX. We just had Rob Casper, who was a executive in residence or an operating partner at KSX, Salt Creek. I mean, there are a number of folks who do this to varying degrees with varying formality in their models. Some are looser, some are better defined. But should we put Thesis in the basket of those? Is this kind of one of those programs with your own characteristics?
That's a fair question. Again, I would say that we're focused on our process, which we feel is pretty unique. But let's talk about some of those folks, because we don't necessarily view them as competitors. We view what we're doing as quite different. Novastone, we've had the opportunity to encounter a couple of their folks out in the wild, if you will, and they're very much folks that are maybe a little bit more senior in their careers and are, they have the capital support, maybe. They're left to their own devices, but they still have to, let's call it, bring something down themselves. They don't have the resources that we provide, and then they have to bring it to committee, if you will, and then potentially go, sort of raise the capital. So there's a couple steps that we've observed with some of those folks that they have that we don't have. We're typically working on a specific thesis with folks, as opposed to, hey, we'll just do manufacturing. Like let's take a look at manufacturing. We're looking at something much more specific. That's been my experience with the Novastone folks. Again, I don't, outside of just kind of the interactions in the wild, don't really know them. The KSX thing is actually pretty interesting. They're public. They have some really capable people on the board. We have folks that we interviewed that ultimately went over to their program, and I won't name names, but we knew what we sort of provided before they went over there, and I can tell you I'm thinking how to put this. We do a lot more hands-on work with the folks that we have than they have available to them inside of KSX. Now that may change as they're kind of growing that program. I've seen that be marketed. It's pretty cool that they're a public vehicle, and they do have a longer term horizon for a lot of the stuff that they do, and I think is in fact a innovation in this space, and they should be praised for that. I'm looking at their financials. I think they're doing a little bit of share dilution, and we'll see how that works out for them. But this is a different discussion. Salt Creek, they've been around for a period of time. We actually lost we're trying to recruit an individual. We had some other things going on, unfortunately, and we had somebody go over there, not from our side to the firm, but somebody we were in the process of recruiting. And I think their model is a little bit more institutional in nature from the standpoint of how they're transacting opportunities, but they're still pretty entrepreneurial. And I think they're focused on kind of much more senior talent that is, let's call it, a little more transaction minded. Whereas I think we're a little bit more operationally minded in terms of the folks that we're bringing in, and we're trying to solve. We're trying to cover a lot more of the kind of like M&A praxis. I need a good operator. I don't necessarily need that operator also be really good at M&A. Like we have that skill in spades, and they're again different skill sets. Was there anybody else you threw in there?
Thank you for that great taste of the flavors of each of these different models. And it seems fair to suggest that your model is analogous, but you're bringing in operators. Now, one thing you said in addition to that is that you're not bringing in operators who are only part of that deal. And I noticed recently you were marketing one of your newer deals, and we invested in a deal with you and Chris Kirch last summer. And I got the outreach not from you for this new deal. Chris is not the operator. He's busy with another company. I got the outreach from Chris. And so that surprised me a little bit. So he's maintaining a role at Thesis Capital at a holdco level, if you will. Can you explain a little bit more about that? Because he's not just a hired gun in the OpsCo, in his case in Puerto Rico. He seems to be more elevated than that.
Yeah, I mean, this goes back to my earlier comment of we want people involved in the ecosystem, right? And not just doing sort of what they're doing. I think cross training is super important. I mean, we let me take a step back and then I'll come back and address your question. But we want the entrepreneurs, our executives in residence, to see all of the sausage making as it relates to getting a transaction done and be a part of things at every stage. Will, going back to your point of like building a relationship, well, Chris has actually spoken to you guys, I think, more than I have spoken to you guys. And so, Chris is aware of all of the deals going on, as are all the other executives in residence aware of all the other deals that are going on at the same time, because we want that visibility into things. And so Chris said, "Hey, I'll reach out to the Minds guys on David's deal."
Are your executives in residence, if you could share anything about their typical compensation model? I believe it varies quite a bit, and it varies also depending on their scope. But also, does their compensation tie only to the company that they are linked to directly, or is there something beyond that, since Chris takes that on to do outreach on behalf of Thesis? Because I presume his Puerto Rico OpsCo company is not going to be, since it's in uniform and linen supply, it's not going to be related to the behavioral healthcare company that he did the outreach about, right?
Yeah, great question. Again, so that outreach is, hey, everybody's trying to be helpful for the other folks. We want, as I mentioned, so it's in sort of our brand a little bit, in that it's Thesis Capital Partners, right? We want people to come into the ecosystem long term as a partner. Now that will unfold over time. How we structure our compensation, well, my comment to your question will be that whales are only speared when they come up for air, and so we'll keep that our secret sauce on our end. But our goal with everybody is for folks to come deeper into the ecosystem over time. And now some folks have said post closing, hey, I really want to just focus on this one thing, and give me all the help you can give me, and I'm going to blow this thing up. And like, absolutely, we want folks to be their best at work. We want to create that environment where they can have sort of maximal success. But so it's different strokes for different folks.
Well, speaking of Chris, Ian, and we've mentioned how your deal with Chris is in Puerto Rico. Talk to us about doing a deal on the island.
Yeah, Puerto Rico's a fun place. They had the Bad Bunny concerts pretty recently. They kind of like blew up GDP, and it's part of the U.S. and it is a actually really critical component of a major supply chain in the United States, which is the pharmaceutical sector. And so something like 17% of the pharmaceuticals that are consumed in the U.S. are actually manufactured in Puerto Rico. And so it's a really tight supply chain because there's only one port in and out. And if you look at where a lot of the domestic, let's call it drug manufacturing is, it's there on the island, and it's been that way since a very long time, and that's not going to change. And part of the reason it's not going to change is because you have really tight controls of your supply chain going in and out of the space. Puerto Rico is, of course, a unique environment in that it's an island. So their island economics are materially different from mainland economics, and so you need to think about that from the standpoint of what is that going to do to growth, what is that going to do to pricing, what is that going to do to labor and these other changes. But what I would say is that there are businesses out there that are just absolutely necessary, and they're going to thrive. And so we were looking the thesis for the thesis for the opportunities that we were evaluating were in and around pharma supply chain. We had viewed this change in, sort of post-COVID recognition that we need to sort of reshore some of our supply chain to the United States is kind of like an obvious wake-up call. We were looking for pharma adjacent opportunities, and one of the things that we picked up on is that clean rooms are increasingly important, and they're going to actually be important on the data room side as well. And so we started evaluating some of these opportunities, and of course, what comes up is 17% of your supply chain down in Puerto Rico, what have you. The other unique aspects are legal and tax is extremely complex, and you need to have both local U.S. counsel and counsel that is local to the island understands the nuance in both tax code and sort of legal elements. And so it, in a certain respects, raises the cost of doing business, especially the cost of M&A. But if you factor in sort of other benefits like the tax structure, it kind of nets out over time.
Ian, this island economics term, is that a term I should know? I know exactly what you mean, and I've referred to it before, but I've never heard it said so punchily. Basically, island economics can be great because there's a literal and figurative moat there. It is surrounded by water, which allows you probably some strong pricing power. It keeps competitors out, right? These are among the good qualities. The quote bad qualities would be limited TAM for the very same reason. It's not a market that can grow beyond the beach there.
Right.
So, anything more to say about that? And is that a phrase I can start using? Did you coin that?
Go for it. Just give me attribution, and I'll take a royalty every time it comes up on the podcast. But the answer is yes. I mean the economics of some of these, let's call it island geographies, including, I would say, like the U.S. Virgin Islands and these other things, are such that in some cases it makes a lot of sense to have folks that are a natural player that are much larger than their nearest competitor, and you just have one player, and everybody kind of knows who that player is, and that applies to your biggest and most complex industries, right? So in our case, pharma, and in other cases, applies to things as simple as your food delivery, or think distribution from the port. As I mentioned, there's one port, right? So they have kind of a natural, both geographic and actual monopoly. So if you're, to the extent you're doing some distribution around there, you're going to have those things. So it creates opportunities where you do have some asymmetric benefit in certain types of companies, and you want to make sure that those companies can also still price themselves sort of at the growth rate of GDP, right? Most companies, broad strokes, in our view, are only going to grow at the rate of GDP. What's really important is that you can continue to price your goods and services at the rate of GDP growth. So that's not always the case in island economics. In some cases, some services get crushed, and you get really challenged in terms of your wage growth and real purchasing power as a function of that.
How was it to do fundraising for a deal in Puerto Rico?
Well, that's you get a lot of no's really quickly. It's like, oh, Puerto Rico, that's complex. I don't understand it. It's not the U.S. We heard the comment, it's not the U.S. a lot, even though it very much is. And you don't need a passport to go there. You can just hop on a Southwest flight from Houston, and you're there in 3 or 4 hours, and it's beautiful. And we have a lot of Puerto Ricans here in Houston, and so we're kind of used to it. But I think the biggest challenge we ran into is, for a lot of folks, it's not clear and simple. It doesn't check the box. It's not something that's like, oh yeah, no problem. Sort of U.S. domestic, lower 48. Like let's get it done. And so they just said we're out. And that was more so an issue, I think, on the debt side than it was for anything else. But we solved that problem. We have some wonderful partners in that business, y'all included, and it continues to be a great place to do business.
Why did you have more issues on the debt side than the equity side, do you think?
Yeah, I think it's there was artificial regulatory concerns. We had to get some partners that were willing to dig in. We had demonstrated, look, we'd done our homework. We looked at this business very carefully, and is getting folks to kind of dig in and do the similar level of homework. Again, not being a more check the box exercise. I think a lot of lenders, not to speak of all of them, but a lot of lenders are looking for that, hey, I don't need to do as much analysis. This is kind of a no-brainer. Let me just kind of check the box and I could underwrite to this within this range. Whereas, like Puerto Rico is there's a lot of GDP that comes out of there. So I'd be very surprised, but there's not as many transactions that are happening on the island. So population is bigger than many states actually in the U.S., but you still don't have as much M&A activity.
What is the population?
Population's about 2.3, 2.4. Last time I checked, it may have. Let me see if I got that number right.
That's okay. I'm not going to error check you on that one. I wouldn't know. I was just curious. But
3.2.
Yellow. What was that?
3.2. I was
3.2. Okay, yeah. Maybe it grew a lot since you did the deal last year.
No, I always try to compare it to Utah, and Utah was like a small town. I lived in Utah for a little bit, and so.
Since Puerto Rico is a yellow flag for a lot of capital providers, does that impact the valuation that you would be willing to pay for a company there?
I think it would for a lot of companies. I don't know in the instance that we participated in. I feel like we paid a fair price for the business, and but I think for a lot of industries it will. To answer your question, for a lot of industries it absolutely will.
So it was a little bit harder to raise capital for the deal, especially on the debt side. Did you at Thesis Capital Partners raise it entirely by yourself, or did you have anyone that you hired or consulted with to help you with that work?
Yeah. So in this instance, we did partner with an investment bank to assist with the debt. There's a number of reasons for that, but the most important reason is that we wanted the right partner. I can't overemphasize for people looking to do this or acquire a business how important it is to have the right partner. Certainly on the operating side, but also on the cap table. And you are in that business for the foreseeable future. Good things and bad things are going to happen. You need to have the right partner. And if you don't have the right partner, like it is absolutely worth your while to retain a partner to help you find the partner, right? Just like you have executive recruiters, you can have a value-added partner that helps you bring to bear that opportunity. And so we are extremely happy with the lending partners that we have in the opportunity, and we would not have had them, or at least one of them, were we not to have the other partner that we brought in.
So this is something like a capital placement agent that you had hired then, is that right?
No, they were formal investment bank.
Okay, got it. So how do you go about finding an investment bank like that who can do this job for you? And how do they evaluate you, and how do you kind of sell them? Because it's a relatively small deal. They can do $1 billion fund and get 2% of that, or they can do a small deal in Puerto Rico. And so talk a little bit about how you find them and how they decide, or how you decide to work together.
Yeah, that's a great question. So it's not dissimilar from the recruiting process I sort of described. We talked to, of course, our network, and we say, hey, look, we're looking for an investment banking partner to help us bring the right lender to bear and for this opportunity. And ultimately, we had talked to, I think it's about probably 6 or 7 investment banks, and I called a friend whom I'd known for a couple of years, described the criteria that I'm looking for in that partner to go help me do this thing. And he said, I can't think of anybody. I'll give you a call back. and then, like 2 days later, he texted me. He's like, "Oh, my brother actually works in an investment bank. You should talk to them." We went and talked to them, described what we were looking for, and they said, "No, we can't help you." and then that information was shared with another partner, and they said, "Actually, no, we know exactly what you're looking for. We can't help you." And so, there's a long way of saying there's a lot of discovery in finding the right partner. And we in this case we had to do some discovery to find the right partner, and that's how that worked out.
How does it work on the fees side? If you could give us some ranges in terms of when you hire an investment bank to help with a capital raise, approximately how does that land in terms of what they charge?
Yeah, so I want to distinguish between there's finders. We've not used a finder, and then there's formal, licensed investment banks that we have partnered with in very particular instances. And there are, let's call it, debt capital raising groups, which are typically associated with or attached to an investment bank generally. On the debt raising side, your costs can be anywhere from let's call it just 1% to 2% of the placement, if not a little bit more. If they're placing some debt plus equity, we've seen people that investment banks that charge as much as like 5% of the total enterprise value, which we've never worked with those partners. We've seen Lehman scale, we've seen half Lehman, but I'd say usually it's going to blend out to something like 2.5% of the total enterprise value. So you have to factor that into, if you're ever going to use one of these investment banks, you have to factor that into your purchase price, right? Because it is a cost to your investors. It is a cost to your capital to use these partners. But the times when it's appropriate are really if you have everything else taken care of, the purchase price still makes sense, and it makes sense to use one of those partners, and you need to find the right partner for the cap table. It can still make a lot of sense to make use of an investment bank, but as I mentioned, 2% of the total enterprise value is a lot. So you got to make sure that the transaction still makes sense given that context. I don't know, these folks who are using these folks are charging 5%. I'd like to see what they're doing that for, but that hasn't happened to us yet. So.
Is 5% for the very small, the smallest deals, would you say?
No, I mean, we had one group that we talked to, and it was like, we'll do deals up to 80, 90 million. And so I think, of course, on the smaller deals, they're gonna try to get you a little bit more, but this is for big dollars that some of these groups were seeking to charge that.
It's gonna say that they want the right capital partner. Of course they do, but that doesn't mean every independent sponsor should use an investment bank to raise the capital.
Yeah,
and so what are the scenarios that where you decide to do this?
There are different sources for debt capital. There's traditional lenders. There are SBIC groups. There's private credit. There's family offices. There's, of course, the seller is a component, and there are other unique products that we've looked at for various deals that are kind of like lend lease, IP, crazy stuff, what have you. So there's any manner of, let's call it, debt products. There are even debt products where folks will give you a loan, and you could just basically pay based on what percent of profits that you have sort of coming out of the business, right? All these sort of things exist. And your source of capital has a number of things to do with how you structure your business, because let's put it this way: there's a lot of sharks in the water at all times, and you need to be very careful when you're doing these transactions, especially if you're doing them serially. And you want to make sure that you're partnering with people who have the best interest of the business long term in mind, and your capital structure can also guide that based on the type of asset, right? So, let's kind of break that down further, right? Certain businesses are going to move really, really quickly, and you're going to need incremental capital. In some cases, when you need that incremental capital, it's better to pay up for that capital. In other instances, and I think this is true for a lot of businesses, you want to refinance that debt because maybe you have a picture or view as to interest rates dropping within a period of time. You want to have a type of financing in place that would allow you to refinance, and you're still basically able to generate a return for that lender and then make use of their capital in the future. And you're just not going to sort of sour the punch bowl, so to speak. That's a 1,000-foot view, but those are instances where it's, you really got to think about your 5-year scenario and what's going to happen.
In the sharks in the water, how to make sure, what is a tell of a shark?
Yeah. That's a good question. You're always trying to figure that out, and you want to make sure it doesn't come to bite you last minute. But the tell of the shark that we've sort of encountered, like I mentioned, like we've gone to the McGuire Woods conference, and again, not to speak ill of anybody, but folks that have presented terms to us were nuts. Like we would never bring our equity parties into transactions that was put forward in a term sheet that was presented by some of these folks, and that can be the interest rate component, that can be the seeking warrants, that can be. We did a deal, not one of our more recent deals, but we had a lender. They're a very serious, very well-known party, and the only condition under which they would do the deal is that they got 10% warrants. And it's like, I'm not going to do that under any circumstance because that's so dilutive to equity that it just sort of doesn't make sense. But the fact that those were the only terms that they were willing to offer indicates to me that there are absolutely people that are getting deals done under those conditions.
So the tip would be get a good sense of what market is before you make any decisions, so that you can identify when a lender is being way aggressive on terms.
I think it actually goes well beyond that. I think actually what you need to do is you need to do the scuttlebutt to figure out how people have acted in deals historically. And so we have friends of the firm, and we say, hey, have you done a deal with this group, and what has been your experience, and how have things gone when they've gone well, how have things gone when they've gone poorly, and you need to know again who's on your cap table, these groups turn over, right, in terms of who's employed sometimes, but usually their sort of philosophical bend in terms of how they act doesn't change too much because the folks at the top typically stay. So so it's that scuttlebutt to figure out how they actually act.
The item about warrants, a very nice nuance there. Do you think warrants are just at odds with the independent sponsor model?
I think they are at odds with equity because the lender is not creating value typically. In many respects, lenders can be a drag on value creation because they can ask dumb questions that require a lot of research and management time to kind of like uncover what those answers are so you satisfy them. I think I understand where it comes from. People are trying to play a little bit on both sides of the table, get a little bit of upside, kind of sweeten their returns. But I actually think it's a disincentive for performance, and we've never done a transaction where we had a lender with warrants, nor do I think we would.
Ian, let's roll back the clock a little bit and hear about the early days of Thesis, or even pre-Thesis. Having just been at McGuire Woods, there are a lot of aspiring sponsors, people who haven't yet done their first deal. So a lot of first-time sponsors listening to this. So what did your kind of first time out or before the first time look like? I think you actually came in via more of a searcher profile before sponsor profile. Tell us the story.
Yeah, that's right. Now, I had participated in sort of serial M&A in a formal capacity, in industry for a period of time. I completed something like $10 billion in deals, but I was looking for an entry vector into acquiring a business or running a business, and then I learned about this was either end of 2016, early part of 2017. I learned about traditional search. You read the formal white papers, et cetera. I talked to everybody under the sun, and I was just immediately convinced that this is what I need to do. Right. So it was the ecosystem then was not the ecosystem of today. It's much more robust than in 2017. I mean, it absolutely just radically different. So it's been wild to kind of watch that occur. So I initially started on the journey to raise a traditional search fund, I should say, and had let's say, gotten 7 of my 15 units. I think I was going for 15 units at the time. I was, bumping around the country, meeting the kind of traditional folks and making my way. And I had gotten the advice from somebody whose name just escapes me right now, but it will come to me, I'm sure, to start looking immediately, right? Start looking for, and that's the advice I'd share to other folks who are looking to do this, is start looking immediately, extend your runway. And I took that advice very, very seriously. I was still employed full time, and at the same time, kind of running around and raising these units, and then found a business. I found a business, and I started shopping that basically to the remaining folks I was trying to get units from. They didn't really like the opportunity, and I thought, well, that's nuts, and I'm just going to do this myself. So I did, and so that happened in September of 2017, and so that was kind of like the first foray into this endeavor.
So Ian, you told the investors that had soft committed, actually, thank you, but I'm going to go my own route with this deal, and then did it all yourself. Can you give us some of the bullet points on that deal and on that business?
I'll give you the bullet points on actually maybe the second opportunity, but on that first opportunity, just to kind of close the loop on that, I asked people if anybody wanted to participate, and the answer was no, outside of, because it was a different structure. It was a structure that I put together. One guy was just livid. I mean, he just ripped into me, called me, like, angry voicemails, like, I can't believe you do this to me, even though, like, I hadn't taken the guy's money yet, right? So that was an interesting dynamic. And then later, of course, years later, I've sent the guy deals, and we're copacetic. So
why do you think that he was so indignant, especially since
I have no idea. I think it's just a bad day, like, it happens.
Oh, okay.
And anyway, so the genesis for, and this is where I can talk about one of the deals, the genesis for who we are today as a firm came from 2 guys who were MBA interns. I had a couple of interns when I was running my company, and they were getting their MBAs at Columbia, actually, older than myself, but they came to me and they said, look, we're operators. We are not, M&A professionals. We can absolutely run a business, but we would need your help to a little bit on the sourcing, certainly on the negotiation, and on the capitalization structure. And so that's Ravi and Sohim. And so they bought a business, Daily/Pro Supplier, and it's actually in India. They have some U.S. presence, but it's in India. And so I'm happy to walk you through that deal. There was a company. They had a number of, sort of brand names that you would expect in the U.S., like Walmart's, Amazon, et cetera, as customers. And they were doing distribution of office supplies. They had a unique model, they still do, of you can kind of order and package some of these things together online. They also had, local suppliers that you could really only kind of get access to from their platform. The business was run by an individual who was suffering from really bad personal health and needed to sell the business. But it had grown almost like a growth business for a number of years. And so this is, we acquired this thing around, let's call it 21, 22. The business had 4x'd in that period of time, right? From, just a couple 100,000 in revenue to, kind of by the year 22, but to about 3 million or thereabouts in revenue, and just absolutely gangbusters growth. Gross profit still not where it could be for a business like that, but it was getting better, and there was a very clear path to expanding into that market. EBITDA, when they started the company, was basically non-existent, and again, they were reinvesting most of that into growth. So it didn't look like your traditional search deal, right? I'd say a traditional search deal, maybe you're closer to kind of like 1.8, maybe 2 million in earnings. It looked almost a little bit more like a venture type investment. But again, it was in India. And so if you kind of peeled the onion back and you looked at earnings and you were to say, hey, I'm gonna take and reinvest those earnings into the business. Here's about how much I'm reinvesting into the business every year, and that was, let's call it $1 million, $2 million. Whereas it wasn't throwing off much cash, and margins were thinner because your net margins are thinner because you're reinvesting a lot of that capital. We structured that deal. There's no SBA. There's no traditional finance over there in terms of like getting a loan. It doesn't exist. Like the ecosystem, the rails, the tools that are available to the entrepreneurs here, capital formation, radically different over there. I mean, it is like Wild West. Like the concept of getting a 5-year interest only loan. Good luck. So we structured that in a way where we had several tranches actually of preferred, and then we had performance earnouts at different stages of performance. So effectively no seller note, effectively no debt, and basically all equity. And so it was probably, I think we paid, let's see, in cash equity, we paid maybe like $700,000 for the business, and we would say that the enterprise value of the business was probably 4 or 5x that. So smaller business, right? But again, this was my sort of first foray into this idea of partnering with folks to help them get that done. And then we had earnout tranches that it was like, first tier was like $100,000, next tier was about $400,000, tier after that was like $360,000, and there were some payout timings on each of those tranches. It was 4 years, 3 years, 3 years, and that was like the last deal we decided to do in India because it was extremely complex, and talk about just like the levels of paperwork and bureaucracy. Puerto Rico was nothing compared to that opportunity.
Well, you're not scared to go outside the continental 48, even though you don't want to go back to India. You then did go to Puerto Rico, and as you've already told us, a lot of people just put that in the too hard pile, and it was an easy no for them. So you don't. Yeah. If international is its own version of hair, you don't seem to be scared by that particular hair.
No, I think what fundamentally matters is, again, the people, right? The people involved. That's the sort of actually the first paint of diligence we get. But then the underlying microeconomics of the asset, right? What are the underlying microeconomics? And there's great businesses all over. You just got to be able to turn over the rocks.
Ian, you mentioned that it's been wild to observe how this traditional search fund model has evolved since you first started taking an interest in it 8, 9, 10 years ago. Could you elaborate on that?
Yeah, I think numerically, the ecosystem when I started was maybe, if you really push pretty hard, maybe 2,000 people, right? That was like the size of the population of people that are interested in this. Maybe it's a little bit more, maybe it's a little bit less, but that's kind of looking back at notes and things like that. And I heard a statistic recently that population size is anywhere from 40 to 50,000 people who are kind of in and around this space now, right? And in no small part because actually the education is better, right? I had to go figure out all this stuff myself. You guys are of course out there, educating, which is going to ultimately lead to smarter capital allocators. To a certain extent, you're making competition a little stiffer, but those tools didn't exist, right? And as sort of there were folks out there buying businesses. Of course, M&A transactions were occurring. It's not like SBA loans were created in more recent years, but this ecosystem of people who are, let's call it, very traditionally considering themselves searchers is, I think, just exploding. I mean, I didn't go to the conference here in Houston even, but one of our local guys did. There's one at the Rice University, I think today, right? That's going on, and I heard that there's about 500 people there. Well, like I couldn't find 500 people in Houston in 2017 if I really tried, right? That just didn't exist. So different ball game, and I think you of course have these service providers who stepped into the space, which is good. It's further professionalized things, but broad strokes, if you go back to the traditional model, the very traditional search fund model, I think that has actually moved to more of a venture play where the traditional investors are really making bets that are not necessarily in the best favor of the entrepreneurs. And they're really trying to get those asymmetric outcomes from a financing standpoint. And, maybe there was some inkling of that when I was doing this, when I was, kind of raising my units on a traditional basis, because I distinctly remember sitting in and across from, in one of the conference rooms, across from one of the known players in this space. And they said, we really make the money when we re-up on a healthy opportunity after the first 5 years. And that had nothing, that conversation that was presented back to me by that individual had nothing at all to do with my view of the world and what I was trying to accomplish at that time. And so I think that there was some sort of burgeoning element of it, but I'm not certain. More importantly, I'm not certain that it's necessarily the best path for most folks. It is a great path for the folks where you have a asymmetric outcome and you're in the top quartile, by any measure.
I'll explain this a little bit more, because I think 20 years ago, traditional search was there to back boring businesses. And so you would go out, and as a searcher, 70% of searchers ended up doing a deal, right? And they would do a 3x, which is a great return for them, a fantastic way to, start your career as a serial deal maker. But if you contrast that to what you're observing now, what's the contrast specifically?
Yeah, I think the contrast is that you're not doing 3x deals. You're paying premiums, very high multiples, in fact, for things like software businesses where you have distribution in theory is free over the internet, and you could in theory have this asymmetric outcome where your valuation is much higher, but that doesn't necessarily. And if that doesn't work out and you overpay for a business, that doesn't mean that your outcome is going to be good as a executive when you're running that platform. It could be okay. I'll tell you anecdotally, the data that I have, and we talked to a lot of people. We can maybe go into that as a topic, but we talked to a lot of people, and the kind of numbers that we're seeing from the standpoint of like earned common equity, like kind of median and mode, is closer to like 1 million, maybe 1.2 million, right? It is not the average, right, of what you're seeing in the search fund study, and it sits behind a preferred class in a number of cases, right? So, I think if you talk to a lot of very serious people who are going into this, they could probably make more money on average taking an executive role in a kind of mid-size or larger company, given the pedigree of the experience that they have, post MBA.
And so what I've seen is that the closing rates now of the funded searchers that were at 70% closing rate within a 2-year time frame or within the funded search time frame, they're now in the 40% range somewhere. Mm-hmm. And that percentage has come down not only because it's more competitive in the lower middle market, but also because their very investors are no longer supporting as wide of a swath of deals.
Right.
And that makes it harder to find the deals that they will support. And the deals that they support are tech-enabled, higher growth, but also overall higher risk. And so if you're a searcher, you might have a 10, 15x outcome here, and then you're golden. Mm-hmm. But the majority of searchers is actually not going to have that outcome. And these more risky businesses, then you end up with not that exciting of an outcome, and you're saying 1 or 1.2 million, which is certainly not a bad payday. But
Sure.
For someone who could have worked in McKinsey for those 6 or 7 years, who has now earned 180K per year, and then they get 1.2 million as a bonus after 6 or 7 years all in, it doesn't actually compare. Is that kind of capturing it?
That's right. I mean, that's what we're seeing. We're again talking to a lot of folks going into space. I mean, I think another thing to remember is if you go into traditional search, there's still not a guarantee that someone will back your deal, right? You have to bring that to those capital partners and say, hey, would you back me? And the other thing to remember is that, and this isn't true for everybody, but a lot of those traditional investors are basically indexing those transactions, right? They're not they're not taking that full cap table. They're going into that cap table basically pari passu with the other people who've already put in their credits onto the searcher, and they're trying to go get 10 of those and hope that, again, inside of that pool of 10, that some percentage are going to perform. And like you said, it's good for the folks where you have the great asymmetric outcome.
So on that, I mean, these search fund investors, the people with the capital, are some of the smartest people in the lower middle market.
Absolutely.
So what is it about it that is compelling them towards, the asymmetric nature, which is riskier for the individual searchers who only have one egg in the basket, right? But why are the investors going that direction? Wouldn't it be better to have boring businesses that return 3x MOIC for them?
Well, I think there's a couple of problems, and I don't know if we'll address all of them, but put it this way: if you've been successful for a long period of time, to a certain extent, you actually have to put more money to work, right? And so where can you do that historically? Actually, these software businesses are capital sinks in a certain respect. If you have something that has a good ROAS that can continue to grow, you can put a lot of dollars to work in some of those opportunities and get a reasonable ROI. I don't know, you get like a VC unicorn ROI, although there's been somewhat equivalents of those. But I think that's a driver. It's not the driver.
It's interesting, this conversation, because I talked to a whole lot of searchers on the Acquiring Minds side on the other podcast. And the decision to go self-funded SBA style search versus traditional search is a fork in the road that many searchers contemplate. And for those who choose to go the traditional search path, there's often I ask them why. So anyway, but the pros and cons of the various models has been talked about a lot and continues to be. I have not heard this point as one of the cons of traditional search, that there is this increasing bias for a certain type of business among traditional search investors, and that the kind of portfolio construction has changed such that the dynamics about where they will invest their energy post-acquisition has evolved and changed to the detriment of 19 out of the 20 searchers. I'm sure traditional investors listening to this will be taking issue with all of this, but it's a really it's a really interesting evolution. And it certainly, if you're on the fence between traditional search and self-funded search, it would be a reason to be tipped in the self-funded direction.
Ian, one last question for you. Going all the way back to the beginning of the conversation, you said that conferences haven't been an effective channel for you to find new capital providers. What are the effective channels for finding capital providers?
I think there is a lack of creativity. There is capital available, right? It's not always even in the U.S. So just like we've made investments outside of the U.S., there are folks. The U.S. is a really attractive market. It is the world's most attractive market. There are folks who specifically want to get access to these assets that are not in the U.S. And I think that increasingly, as it becomes, let's call it much more normal to make investments in U.S. lower middle market. In fact, you have a lot of really large capital providers coming down. I think that you're going to find that there's international groups that want to participate in the market as well. And so I would think that really savvy operators, really savvy capital raisers, really savvy independent sponsor platforms, et cetera, are starting to recognize that the U.S. is still the most attractive market, and that there's other folks that want to get in to these attractive deals that have a capital appetite that is right-sized to these types of opportunities, right? They don't want to cut $1 billion check to a Blackstone or a KKR or what have you. They want to allocate maybe 5 to 10 million to some of these smaller deals.
So these would be Swiss family offices, for instance.
Yeah, I don't have any Swiss family offices, but it'd be nice to have one or two of those. But yeah, I think I literally think it's Europe. I think it's Latin America. I mean, I think it's parts of Southeast Asia. We've had a number of conversations. I think the quote on when you speak to a family office, when you speak to one family office, you've spoken to one family office. I think that's the phrase, and that's absolutely the case. But that being said, there's folks who are looking, I think, to deploy stateside.
Ian, before we let you go, I actually do have one final question for you.
Sure.
For those listening, and many of them will be aspiring sponsors, maybe haven't yet done their first deal. Maybe there'll be some searchers listening. What is the profile of person that you're looking for what was the title? The executive in residence?
Executive in residence. With us, it's executives in residence.
Thank you. Executive in residence. Who should reach out? What's the profile of person you'd like to reach out?
Yeah, it's you're not necessarily a transaction professional. If you've done M&A and you still want to operate something, we're happy to talk to you. That's not a disqualifier. I would say, we look at 20 different data points, but and I won't give all 20 here, but I'll talk about the main ones for us to actually be helpful to a given party. There's kind of the brilliant jerk quadrant. There's brilliant, just not brilliant. There's jerk and not a jerk. Your job is always, our job at least, with how we're running the kind of business from a no jerk standpoint, is always to figure out who's that brilliant person that's not a jerk, and make sure they're in that quadrant. So I think that's step number one. Of course, we want that honesty, intelligence, initiative, sort of Buffettism there. But I'd say in particular, we're looking for folks that are very autonomous, and I'd characterize that as independent, self-accountable, internally motivated. Those are sort of measurable components. We need someone at a certain energy level that needs to be very, very high, because you're just going to have to run through a brick wall sometimes, and some folks really just can't do that. It's like, hey, I'm a 40-hour-a-week guy. Like, you're going to have a real hard time in this. It's just not going to work out for you statistically. We do. Of course, we want people who are honest. We have some ways of testing for that. It's not perfect. We have some behavioral tests for that. It is far from perfect, but we have some mechanism for that. And then we, of course, need somebody who is really, truly humble in the way that they are open-minded, modest, and specifically receptive to criticism. It is a more rare person than not that can take in criticism and actually turn around and sort of make hay with that, right? Change their perspective on how they're operating, how they're executing their executive functions with and among other people, and then improve their situation. You have a lot of folks who don't take criticism and ultimately do anything with it, and that's also measurable. And then I'll just sort of anecdotally, one of the things that we do when we're doing kind of reference checks is instead, reference checks, you always get people who they give, this person's the best person since sliced bread, da 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 da. Everybody gives you something positive. We tell the people that we're talking to when we're doing the reference checks, we say, we're talking to you because we already think this person is great. That's a given. We wouldn't be having this conversation with you if we didn't think this person was great. I'm calling you, and we have a couple of variants of this, but we say, I'm calling you to understand what this person's specific weaknesses are. And I want you to tell me what their specific weaknesses are. And usually we get fantastic results out of that in terms of understanding what someone's weaknesses are. And so again, we build this really detailed profile of folks, and we look against those 20 criteria, and we have interesting ways to kind of get at some of that information, just like tell me about a person's specific weaknesses. And we get some really interesting conversations out of that.
And then Ian, in terms of kind of professionally where somebody is or what they're looking to accomplish, maybe a former or current searcher, maybe a former or current sponsor, or somebody who went down the path and maybe wants to work with somebody else, somebody looking for a partner, like what is the kind of professional profile or what they're looking to accomplish professionally that would be a fit for working with you at Thesis?
Yeah, I'd say if you're looking for a true hands-on partner in this process, a really hands-on partner that's going to work with you at every stage of this thing, from acquisition to post-closing, and you've got some of the behavioral characteristics that we described, and you have a differentiated view of the world that you need to actualize, but maybe you're a little bit more on the operator side. We'd love to have a conversation, right? We would absolutely love to have a conversation. We talk to maybe 300 people for every one person that we work with, right? And that's a lot of people. I mean, it's one of the most important things that I do is talk to folks. And we probably have 10 conversations a week.
All right, Ian, we will let you go. Thank you for sharing what you're doing at Thesis. We're really excited to be in your deal with Chris in Puerto Rico. So that was an exciting one. We hope you'll continue to bring us your subsequent opportunities. And we will provide a link to Thesis and your LinkedIn in the show notes. Thanks for joining us on the Minds Capital podcast, Ian Reynolds.
Thanks, Will. Thanks, Nicholas. I really appreciate it.
Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital podcast wherever you listen to podcasts. You can also watch us on YouTube. Also check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraisers. See you in the next episode.